Welcome back to Investor Prime TV. If you're new, make sure you subscribe and of course follow me on Instagram at Investor Prime. Alright, let's get into today's video. In today's video, I'm going to be discussing with you swing trading and in particular a strategy that works. So swing trading is more for longer term investors as you'll be holding a trade for 1 day, 1 week, 1 month, etc., or even up to a year. With swing trading, you don't necessarily need high leverage as you're holding trades over a couple of days, weeks, months, even up to a year. So you're able to lock in those bigger profits.
Hi guys, today I'll be sharing with you a swing trading strategy that works in the long term, especially if you're a long-term investor. You just want to place your trade and you don't want to be looking at it necessarily every day. You can go about your business, do everything else you're doing, and then come back and check the money's made money for you, or if you need to adjust your trade. So a good strategy to use is the golden cross or the dead cross. So this involves the crossovers of two moving averages, usually a fast moving average or a moving average with less periods in it, crossing over a slow moving average, a moving average with more periods in it. And I'll explain exactly what I mean. So let's plot on this chart of Apple the moving averages so I can explain to you the golden cross and the dead cross strategies. So within the moving averages, you have a simple moving average and a moving average exponential. So the difference between this is basically a simple moving average is less sensitive to the price action or the price movements, whereas an exponential moving average is very sensitive to the price movements. So exponential moving averages would be good for like day trading, scalping, etc. But you want simple moving averages for swing trading with one exception, and that exception I'll go through with my strategy. All right, so I've changed the periods of the moving averages. So as you can see, one moving average crosses over the other. So the 9 moving average, which is the highlighted moving average, is the faster moving average because it's got less periods in it. And the 20 period moving average is the slower moving average. As you can see, when one crosses the other, the price generally follows that moving average. So if we click here, that's the 9 period average. The minute the 9 period average crosses the 20 period average, the price generally moves in that direction because it's said to be a golden cross. So a golden cross is basically changing direction towards the bullish move. So in an uptrend, or a dead cross is a change in direction towards the bearish move or in a downtrend. So as you can see here, this was a golden cross, 9 period moving over the, as you can see here, this is the golden cross, the 9 period moving average crossing the 20 period moving average, and it continues to go until the 9 period moving average crosses back over the 20 moving period average. So now let's get into the actual strategy that you'll be implementing for good results. So the parameters I use for the moving average is the fast moving average. I actually use an exponential moving average crossing over a simple moving average. And the reason for this is I want to get into the trend as quickly as possible, likely before it becomes a trend. So that way I can ride the trend up or ride the trend down, depending on which direction I take. So the settings I'll use, I generally tend to stay in the market for about a week up to a month. So I want to know what the market is going to do within the next month, or from at least a week to a month. Okay, so the parameters I'm going to use for the EMA, the exponential moving average, would be the length. I want that to be 5 periods. So basically I wanted to take data from the previous 5 days, i.e. the previous 1 week of trading. So that's why I choose the value of 5. Okay, and the slow period moving average or the simple moving average, I want to use that to be 22 because there's 22 trading days in a month when you exclude weekend days. But you can go ahead and choose 30 periods if you want a smoother plot or over a longer period of time, but I prefer 22. Okay, so in a way, these are custom settings. Okay, so let me go ahead and change the colors. That way it'll be easier to spot. So I'll use the EMA as red, and I'll use the SMA as black. Okay, so that way you can clearly identify when there's a cross. So this is the chart of Apple. Okay, so let's look at when the last good bull run happened. All right, so as you can see at this point, okay, here there was a golden cross, so the EMA crossed over the SMA. Okay, so let's just make this bigger. So as you can see, it crossed and closed at $66 roughly. Okay, so the strategy with this is basically you get in, if you're looking to be bullish, you get in on the golden cross and then you exit on a dead cross. Okay, so this being the golden cross, we'll get in around $66. We could either buy the stocks outright if you've got the capital for that and you buy the number of shares, etc., for the long run, or you can buy options contracts on it. So those will be a lot cheaper, but you can hold the stocks, or you can hold 100 shares for up to a month, 2 months, depending on how long you want this move to be, and lock in as much profit as possible if it goes in your favor. So this would have been a good time to buy options. Okay, so the golden cross happened at $66. Okay, continue rising. So that was a good time to get in on a very good trend. It kept rising. It looked like there was going to be a dead cross at $93. The bulls quickly took control over the market again, or took back control over the market and continued going. Looked like it was a temporary correction of the bears as the bulls took over and continued going, moved all the way up to, at the peak, really where bulls last had control, $135, but the absolute peak was $138. So that was a great run. But if you're waiting to exit on the dead cross, okay, you would have exited at $113. So effectively from $66 to $113, you're talking roughly around $50 move, approximately $50 move, which is pretty amazing. So you can easily see how you can make so much profit from a move. And that move started in April and effectively ended in September. So you're talking about 6 months, so you'd have made a lot of profit in 6 months. So that's pretty much the golden cross strategy when you get in and when you get out. Now, of course, you don't have to wait till the dead cross, but in terms of eliminating or reducing as much, in terms of reducing the chances of your emotions getting in the way, I follow the dead cross, golden cross strategy, regardless of what the market is doing or how much profit or how much loss I'm currently in, because I take all these into account in my strategy before I get into a trade. So that's with the golden cross. Okay, so let's look at another market. Okay, so that was a stock market. So let's look at a forex market. All right, so let's look at New Zealand dollar, US dollar. Okay, so as you can see, the strategy for golden cross also works well with forex markets as well as stock markets. Okay, so you would have got in here on this golden cross. Technically, you could exit here as this is a dead cross, but I would have held on as this is a bullish candle, showing that the bulls possibly still have control, and it shows that they did, as there was also a golden cross, and then the bulls continued driving the price up until the actual dead cross confirmation on this candle. So of course there's times where this doesn't work. As with any investing, there will be times where it might not work in your favor, so you need to be aware of this because it's not going to work 100% in your favor. Okay, so one of the times was here. So assume you got in on this candle. Okay, so you would have got in at this point. Okay, so where was the dead cross at this point? You would have lost that trade because you would have gone at this golden cross, exited at this dead cross. So this is why it's key to have stop losses, and I'll discuss stop losses in a minute once I go through the dead cross strategy. Okay, So that's an instance where it doesn't work. Okay, sticking to this Forex chart, let's look at the dead cross. And as you can see with the dead cross, it's basically when the faster moving average, or the moving average with the less periods, crosses the slower moving average, or the moving average with the most periods, or with the more periods. Okay, so at this point, we'll get in at on this candle, which is the 15th of January. You're getting on the sales, selling the New Zealand dollar against the US dollar. All right, at this point, and then you hold on to it until you see a golden cross, which is an indication that the trend is over and the trend is about to change direction, either temporarily or permanently. But either way, you need to get out. Okay, so we got in at this point, at this price. Okay, so let's just extend this. So you'd have gotten on this candle, and I always get in regardless of the candle. If it's a bullish candle or a bearish candle, it doesn't matter. I just get in when there's a dead cross or a golden cross. Okay, so you would have gotten at this point, and then you would have exited effectively at this point. All right, so you would have pretty much, so you would have made this profit. All right, you would have made this huge move in, so 15th of January all the way to April. So in 3 months, roughly 3 months, you would have made this huge move, you know? So this strategy works more often than it doesn't. All right, so if you're a long-term investor, this is a great strategy to get into, but you must be using the daily, weekly, or monthly time frame for it to work. I prefer the daily because I'm in and out of the market within months, up to a week to months, you know. Okay, so that's the dead cross. Now, if you were to use, now for you to place your stop losses, where I would advise, or where I place my stop losses when I'm using this strategy is, for instance, if there was a dead cross here, if we got in at this point, where I would have placed my stop loss is pretty much, in terms of Forex, I'll place my stop loss maybe about 150 to about 300 pips above the moving average, because that's my risk. I'll factor in how much I'm risking to lose relative to the pips. So if it's, let's say, 100 pips, let's say I'm risking maybe, let's just assume I want to risk maybe $300 on this trade because I'm looking to make $600+ on the trade. So a 2-to-1 risk reward ratio. Okay, then if I'm risking 150 pips, then I'll place my 150 pip stop loss. And then when I'm setting up the trade, I'll place maybe $2 a pip or something. Okay, so I'll place my stop loss roughly around here. So I have this move. And the reason for this is because the slower moving average is acting as a resistance. All right, so the slower moving average acts as a resistance. As you can see here, this was a great resistance. The bulls tried to take charge, but this acted as a resistance and the bears took full control. Okay, so you have that cushion, and if there was a close above the moving average, you're not going to panic because you still have all this room for it to move. And for it to clear 100 pips, there needs to be a drastic move. Okay, so you still have time to get out of the market at a smaller risk or smaller loss than you set out to risk. Okay, so that's for the dead cross, setting a stop loss. And of course, the only thing to bear in mind when you're setting a stop loss, if you're struggling to know how to set a stop loss or how to calculate your stop loss, you always start with your risk. Basically, look at your capital, how much money you have in your account, and then think about how much money you're willing to risk if you were wrong on this trade. The maximum amount that you risk. So that's that for the dead cross. And if we were to do this golden cross, the same applies, only it's flipped. Okay? So you would get in at this point, all right? And your stop loss might be 150 pips below this low moving average. And my take profit maybe be about 2 to 1. Okay, so I'll be looking to make 300 pips on this move because I'm risking 150. But it shouldn't be cast in stone, as you should be as dynamic as the markets. Okay, so if the markets are changing, let's say it's going in your favor, all right, you'd be like, okay, that's fine. But if it could suddenly go against you, you have to also change and adapt to your plans. All right, you have a lot longer time to decide what you're going to do, you know. So an advice for that, so what I do in terms of locking in my profits, okay, if I'm forex trading, if I'm stock trading, even if I'm options trading, what I do is, as the market is moving in my favor, let's say I got in at this point on the golden cross, as the market is moving in my favor, then my stop loss is also moving with the market.
There you have it, guys. A strategy for swing trading, if implemented correctly, will yield a lot of profits in the long run. Hope you enjoyed that video, guys. Make sure you like, comment, and subscribe. And if you're new, make sure you subscribe and also hit that notification bell so you don't miss my next uploads. And make sure you check out my previous videos, as there's a lot of valuable information. Happy trading, guys.
It's not a game, it's a rich thing.